Hi, my name is Greg Rehmke. I direct a program called Economic Thinking. I've done workshops on the economics of high school and homeschool debate topics, and this is a quick overview of one of my presentations that is available for your debate club. So, economics and debate, banking, finance, and monetary policy. Now, the economicthinking.org website is broken right now. Links don't work, but we have a Facebook page, Facebook / economic thinking monetary, and I've got posts there on various topics related to your resolution. So obviously on this topic, banking policy, finance policy, monetary policy are the broad range. It's a wide topic with lots of complex ideas. But basically you have this question of, you know, the resolution, how should the government manage the money? How should the government manage regulation of banking and finance? And one question to start with, whether it's economic theory or free market ideas, is why is the government involved at all? Why does the government build and own roads? Why does the government run foreign aid? Why does the government subsidize agriculture and regulate it? These are past STOA resolutions, and people that debated those topics know that there's private roads in American history. There's private alternatives for pricing roads. There's private foreign aid investment from companies, foundations that maybe are more effective than federal foreign aid programs. Agriculture, a lot of the regulations and subsidies in agriculture counterproductive. You could argue the same for healthcare. And in education, of course, if you're from a homeschool background, education happens whether the government funds it or not. And so you could make the case, for more government in each of these, but there's a strong argument, economic argument against government involvement because government has certain systematic problems with information and incentives. Government lacks the information to manage the system. Government officials often lack the incentives to carry them out. So with money, this is very much the case. And so what does the government have enough information to manage banking policy, finance policy, monetary policy? Does it have the right incentives? Well, one way to look at this is to look at the history of it. Did government always provide money? Does government always regulate banks and finance? And in fact, banking and finance is the most heavily regulated part of the U.S. economy, along with healthcare. Could we reduce those regulations to get a less complicated, less costly, more effective system? Or others say, hey, we need more regulation of banks and finance companies. And this is the constant debate in a mixed economy. When things go wrong, like the financial crisis from 2009, or perhaps the upcoming financial downturn caused by the coronavirus, is that the private sector's fault or the current administration or the last administration? What should we do? Do we need more government, more subsidies, less government, less subsidies? So in theory, without government, for the money topic, how could money be provided? Would private firms supply adequate and safe money? Could McDonald's issue its own currency, backed by Big Macs and French fries? Or Burger King offer its own Whopper-based currency? These would be commodity-backed currencies. It would be money that you could exchange from person to person to buy things, and you could always use it to buy a Whopper or a McDonald's or a Chick-fil-A or In-N-Out Burger. So it sounds crazy to say hamburger companies, fast food companies could issue their own currency, but in fact, currency is whatever people accept as currency. Vegetarians might not like to get McDonald's backed, Whopper currency. Maybe all that sounds crazy, but there's a background to this, which is most money through all history was backed by a commodity, and that's gold and silver. Most American currency through history was gold and silver backed. Gold and silver have intrinsic value. People value them in and of themselves for jewelry or other uses. So the currency, the dollar, was used to buy and sell things. Its value was ensured by the value of the commodity and the promise of government, of the federal government, that it would, or the bank, that it would give you gold or silver in return for your currency. Now, we have had fiat money, paper money in America during the Revolutionary War, during the Civil War, and since the establishment of the Federal Reserve and its switch over to paper money. So a background debate, should we have commodity-backed currency like a gold or silver standard, or is paper money okay? And if paper money is okay, how should it be managed? What rules should the Federal Reserve have? So those would be background issues on monetary system, and then separately cryptocurrency, could Bitcoin or other Libra, other currencies backed by electronics be adequate? So why have governments monopolized the provision of education in most of schools and money? What's in it for the government? Well, in education, the schools tend to present government as a good thing. Kids that go to public schools generally learn that government needs to do this, government needs to do that. The things they learn about the Great Depression, the Industrial Revolution, the Great Recession, often say that government came to the rescue, to reduce child labor or other things in history. It's worse in some sense. In Japan, government textbooks now talk about Japan's role in World War II as being, the good guys, that they were not bad. Same with communist China. Their education system presents the Communist Party, the communist government, as good and healthy and productive. They erased the Tiananmen Square massacre or the 40 million who died during the famines of Mao's agricultural reforms. So government control of education is dangerous, partly because the government tries to paint a good picture of itself, whether it deserves it or not. Government provision of money can be dangerous for other reasons. The main reason government is in the money business is to make money, right? To facilitate taxes and government borrowing. So the U.S. government is in debt, a deficit $1 trillion this year. That is, the federal government is spending $1 trillion more than it took in through taxes or other sorts of income. And the role of the Federal Reserve and the Treasury is to finance this deficit, right? To keep interest rates low, to facilitate government borrowing. And you could argue that's not a good thing in the long run. It's okay to run a government to run a deficit during a recession or during a conflict or war or disaster. But over time, through American history, the federal government ran a surplus every year, mainly because it was paying down the debts from the previous war or financial crisis. And our government should have been running a surplus over the last decade to pay down the debt so that it would have money and borrowing power available for the next recession. So anyway, background on money. And again, you can skip through this and look at the overheads if you want to move ahead more quickly. So the history, did government always provide money? Well, it didn't in Scotland for 150 years. Scotland had a private banking system where each individual bank issued its own currency backed by that bank, and they had a system where the banks would back each other's currency up. It worked very well. In fact, this was the fastest economic growth maybe in the history of the world, where Scotland went from a deeply impoverished country to the wealthiest country in Europe and the world during the same time that it had private banking. Canada had a private banking system for 100 years, no government regulation of banking. New England did for 40 years, and basically 50 different times around the world, different countries, different times, where money was provided by private companies, private organization, and federal state involvement was minimal. The central government always wants to borrow money for war and for operations, but it's only sometimes had its own bank. So we're used to government always running the money and Federal Reserve monopolizing the provision of money, but that's not been the case through most of U.S. history, most of world history. I was traveling to Europe for some programs last summer and going through my drawer of currencies that I've collected over the years. I found this 20-pound note, good in the United Kingdom. This is actually a private currency. It's issued by Clydesdale Bank in Scotland, 20 pounds sterling, the same as a 20-pound note from the Bank of England. But this is a vestige of Scotland's private currency where banks issued their own currency. So this is backed up by Clydesdale Bank. Now, next up, when I'm doing my workshops, I play a short video by Larry White on this history of private banking, or free banking it's called, and the previous slide with the examples comes from this video. I'm going to skip through it here. You should be able to click on a link that either it'll be on the screen or is separate in the overheads, and you can watch this video. And so, if you wanted to run a case calling that America should switch to a free banking system, that's a legitimate case. Now, you may have trouble because judges don't have much exposure to it. It seems crazy, but it's not crazy to people who understand history, people that understand economics. And at the least, you don't have to call for abolishing the Federal Reserve or abolishing, the status quo. You just say that private banks, if they want to issue currency, should be able to. It shouldn't be illegal for McDonald's to have a McDonald's-backed currency or Starbucks to have a Starbucks-backed exchangeable currency. Anyway, so this is Larry White's video, and I'm going to skip through that again. Background to the topic, what is money? You learned this in an economics class. Money is a store of value, right? You earn income now, but you might want to spend it later. You can have a little stack of cash that you can put under your mattress or in a drawer. Part of what money, whether it's U.S. Federal Reserve banknotes or dollars, whether it's Japanese yen, euros from Europe, 20-pound note from the Clydesdale Bank, or gold, money is a store of value. It stores the value from now until later when you need it, provides savings. Money is a medium of exchange. Obviously, you earn money. Let's say you're coaching debate, people pay you. You can use that money to buy clothes, buy a hamburger, so forth. So it's a way of facilitating exchange. Otherwise, we have barter, right, where you have to find somebody who wants what you have, and you want to make money coaching debate. You have to find somebody who wants to coach debate, but you want some more clothes. So you have to find somebody who has clothes or makes clothes who wants debate training. That's just not going to work. So that's the barter economy. Money arises, whether it's seashells or tobacco leaves or whatever, as a medium to facilitate exchange, to lubricate exchange. And the third thing that money does, it provides a unit of account, a way of finding out. Let's say you're running a company. How do you figure out if you've made money in a year or you've been profitable? Well, you use money to evaluate how your company is running, whether it's profitable or not. So it's an accounting. It helps for accounting. So money does these three things. And how well it works is how we decide whether it's good money or sound money. You could say, is the US dollar managed by the Federal Reserve, is that sound money? Well, it's lost some 95% of its value over the last 100 years. So for long-term investments, dollar has gone down in value. It was going down in value rapidly in the 1970s. It's going down in value slowly now, but the store of value is one of the uses. So you could say if the dollar is great as a medium of exchange and a unit of account, but the federal management of the dollar isn't working as a store of value because the Federal Reserve is not maintaining the value of the dollar. It's allowed it to drop through inflation. So if you want to learn more about the economics of money, there are online economics courses. There are many. This one, Marginal Revolution University, I recommend mru.org. They have a Principles of Economics course, and part of it is macroeconomics. And macroeconomics includes an overview of money. You can take the whole course for free. It's just overheads, and Tyler Cowen and Alex Tabarrok talking about explaining economics. They're authors of a popular college textbook. But for the money topic that you have, banking finance topic, there are a number of videos. The Puzzle of Growth. What's the role of money and finance in growth? Zimbabwe has suffered from hyperinflation, as has Venezuela. How come? How do we prevent that from happening in the U.S.? And then there's another video about the Federal Reserve and the Great Recession. These are relevant to your topic, understanding how the Fed works, understanding about the Great Recession, which was like the 2007 or 2008, 2009 dramatic drop in the stock market, the financial crisis. So you can go into their online course and you can take, this is looking through the the principles of macroeconomics, and particular parts of it. It's all valuable, but the savings, investment, and financial system is the background to this topic. So you can watch those videos and understand those principles of how the system works. Saving and borrowing. What do banks do? What does the stock market do? The bond market? Financial intermediaries. In this resolution, there are all sorts of federal regulations, banking, finance, monetary, that critics argue hamper the system dramatically. So there's many cases for reforming these, but you should understand the background of how the system works in order to evaluate other people's proposals. There's also personal finance and other parts. And then there's for monetary policy, there's a look at inflation and the quantity theory of money. So Zimbabwean hyperinflation, how do you measure inflation? What is the quantity theory of money? With the financial crisis we're having now because of the coronavirus, there's going to be a change in the velocity of money. That's going to require the Federal Reserve to make sure the money supply stays stable. And so the quantity of money times the velocity is part of that equation. And so to get a sense of that, you can go through these sort of presentations on monetary policy. Looking at the history of money, different cultures have used all kinds of money, all kinds of things in the past for money. This is the island of Yap in the Pacific, and they use these giant stones with a hole inside as money. And the benefits of that, nobody can steal your money. It's too heavy to move. There's no inflation. It's very hard to make this money, but there's downsides as well. But lots of different things have been used for money in the past. For research on the topic, there's a lot of think tanks, market-oriented think tanks, who focus on sort of sound money policies. Heritage Foundation, American Enterprise Institute, Cato Institute, American Institute for Economic Research. So you can look at their studies, and you can find these organizations and just look for their money studies. And a lot of this is going to be relevant for cases that are popular, so I encourage you to research these ideas. I'd also recommend two documentaries, or one documentary. It's called In Money We Trust, and it's inmoneywetrust.org. It's a PBS. It was shown on PBS. It's an hour-long documentary. John Stossel has a money, sort of a trailer introduction to the money one. So it covers American history with money, the principles of sound money, and I recommend it. And the links will either be here or in the overheads that I send out. Oh, here's the link. So Stossel in the Classroom has one link, and inmoneywetrust.org. In my workshops, I play the 4 or 5 minute Stossel intro to this, but I'm going to skip over. I encourage you to watch In Money We Trust for a background on the topic. Okay. You can skip over this, skip ahead, but on any debate topic, the role of history is critical as well as economics. So if you were to call for changing the U.S. banking, finance, or monetary system, you should have at least a grasp of American banking history and financial history, monetary history. This is good in and of itself, but also for your judges. They'll appreciate that you have some background on American history, some knowledge of some of these issues. So since the founding of the country, there's been a debate over whether we should have a central bank. So Thomas Jefferson very much against it. The Federalist, Alexander Hamilton, John Adams wanted a central bank. So we've had central banks created, inflationary consequences. Andrew Jackson canceled one of the central bank when he was elected. But central banks and paper money were part of to pay for wars and internal improvements. The nationalists or federalists said they were important. The federalists said they were ripe for corruption and crony capitalism and were very skeptical. So Federalists versus the Anti-Federalists, the Democratic Republicans versus the Federalists. Democratic Republicans became the Jeffersonians. But this is a theme through history. Anytime in debate that you can mention Alexander Hamilton or Jefferson or other the founders, that's a positive influence for the judges, and it's valuable in and of itself. So you've got a battle over the narratives in the history of banking. For those people who tried to run a gold standard case, they're probably inundated with arguments against the gold standard and established economists saying the gold standard could never work, we can never go back to the gold standard. But really, advocates of a gold standard are calling for sound money, a commodity-backed currency that can't be inflated, that the central bank can't just print up the printing presses and flood the economy with dollars. So the narrative of the critics of gold standard is that the government should be able to manage monetary policy. It should be able to stimulate the economy with money or do these various things. The elites that call for this think they're good at it, think it should be done, and think it worked in the past. And they argue that the gold standard didn't work. But we had different gold standards. We had, and some gold standards worked better than others, but the argument is the central government tends to make systematic mistakes. It did during the Great Depression, it did during the financial crisis, and it may again. So centralizing and reforming the gold standard with the Federal Reserve is part of that history. And then the era of the classic gold standard to World War II, which was the largest economic growth in the history of the world, that's often confused with the managed gold standard that came after World War I. So again, just as your background history, the judges will appreciate this. It's important to know we went off the gold standard earlier with the Bretton Woods Agreement after World War II. It was trying to reestablish it after the war, but it was a managed system. So everyday people couldn't have gold. Roosevelt forced people to turn in their gold, but but the system allowed for international gold-backed system. So if we printed a lot of dollars and France wanted their gold back for the dollars, they would send the dollars to us and we would send the gold to them. But President Nixon closed the gold window. He went off the gold standard, the mini gold standard that we have, or partial gold standard what we had. And once he did that, inflation took off. He did that because under President Johnson and President Nixon, they were financing a massively increased welfare state, the Great Society program, and they were funding the war in Vietnam, and they didn't want to raise taxes to pay for this. So they inflated the money. They just printed more and more money. Well, the dollar was used as a reserve currency around the world since World War II, and other countries, particularly France, they were making goods and services they'd send to the U.S. and they got dollars in return, and they were skeptical that these dollars were really backed. They could return these for gold. So when they asked for the gold, President Nixon said no. He blamed the president of France, and he said it was temporary. You can watch the videos. We're temporarily going off the gold standard, closing the gold window. But in fact, we never went back on it, and inflation dramatically increased. That was damaging to the U.S. economy, led to very rapid inflation in the 70s, and so the history of that is important. We have Keynesian, monetarist, and Austrian theories of the business cycle, and that ties in with money policy. But we had, after Nixon closed the gold window, then President Ford took over after Nixon was impeached, and then Jimmy Carter came, and inflation just took off. It just took off. We had stagflation, high unemployment, great inflation, which Keynesian economists said couldn't happen. Then late in Carter's administration and during the Reagan administration, the Federal Reserve Chairman was Paul Volcker and later Alan Greenspan, and they sort of pretended they had a gold standard. Particularly Alan Greenspan, he tried to manage money so that the dollar would stay on par value with gold, and inflation was squeezed out of the economy. So we had 25 years of stunning economic growth, rapid increase in employment, flourishing businesses. America led the world during this time of sound money that started with Paul Volcker and then Alan Greenspan. So the story of why we need a sound money system, whether it's a gold standard or a quasi system where the Fed uses a formula or rules to keep the money value stable, that's what led to rapid economic growth. And the argument is at the end of Greenspan's tenure, after 2005 or so, They got spooked after the 2001 financial crash, and they pumped too much money into the system, which led to increase, too low interest rate, increase in home loans, and the housing and financial crisis that followed. So, again, government could manage money in theory, keep the money stable, treat dollars as if they were gold, but in fact they tend not to. They tend to make mistakes, increase the money supply too much, constrict it too much. And those sorts of problems, they say, well, look, you should have rules to manage the Fed would be one reform. That's John Taylor of Stanford has the Taylor rule that is a formula for having the amount of money grow at the same rate as the economy. And there's others who say we shouldn't have the Federal Reserve at all. We should have a gold standard or private banks issuing their own currency or Bitcoin and other cryptocurrency that allow people to opt out of government money. So anyway, many alternatives on this topic. And here's the background chart on this. So when we had a gold standard, we had stable money from 1800 till the end of the gold standard, which in Roosevelt 1940, the money keeps its value for 140 years. We go partially off, we get some inflation, then the gold fix, the gold window is closed under Nixon, and we get rapid inflation. Right, from 1970 to 2000, 2020 now. Now you could say that, hey, inflation isn't so bad. The economy grew dramatically from the 1960s. We've had tremendous economic growth. How bad could it be? And there's a case to be made from that. We survived. But economists argue, or sound money economists argue, that we'd be better off if we kept the value of the currency stable. The economy would grow faster. The erosion of the middle class people complain about over the last few decades, the financialization of the economy, is mainly caused by lack of sound money, by this huge effort by bankers and finance companies and currency traders to manage our floating system with so much inflation. So a lot of money that would have gone to workers and Main Street instead goes to Wall Street. So that's a case that can be made. Another case on this is things are okay now, or at least they were until this financial meltdown with the coronavirus this week. But in reality, $1 trillion a year deficits and unsustainable Social Security, Medicare, Medicaid, those can't be continued. And what they say about things that can't be continued, they won't be. So the sort of analogy is somebody jumps off a 60-story building, he's falling down, and somebody opens a window on the 30th floor and asks him, how is it? And the guy says, well, it's fine so far. So our inflationary system, may have pushed us off the top of a building. We're fine so far, but Social Security is running out of money. State pensions are running out of money. Medicare is unsustainable. $1 trillion a year deficits are unsustainable. Somebody is loaning the U.S. government $1 trillion every year to spend money on all sorts of things, and we don't have the savings to pay for it. So someday that bill is going to come due. So you could argue we need to put our house in order now by moving to a sound money system before it's too late. And again, this is an obvious problem, right? Why should we have this massive inflation? And some examples of that, I asked students, who stayed in a Motel 6. Some students have. I asked them where'd the name come from. Nobody seems to know. Even their parents don't know. Well, it turns out Motel 6 used to cost $6 a night. That's where they got the name. We've had such inflation since then that no one would want to stay in a $6 a night hotel. It'd be too scary. But inflation has reduced the value of the dollar. That's been Federal Reserve policy, unfortunately. Now, another reason Motel 6 is more expensive now is they have nicer rooms. They've got color TVs. The old Motel 6s were, less. So that's maybe part of the change. Super 8 Motel came out a few years after Motel 6, and they charge $8 a night. Anybody who's played the game of life, it's a board game. I played it when I was a kid. The version I had, doctors made $10,000 a year, lawyers made $8,000, everyday people made $6,000 a year. Well, again, because the value of the dollar has gone down so much, we have to make 50, 60,000 at a minimum to have the kind of lifestyle that people had for 8,000 years ago. So we take it for granted that money has lost its value, or we don't notice it because it happens so slowly. But when you look back in history, you see it's happened, and it didn't have to happen. It didn't have to be this way. It's caused a distortion in the economy. Okay, so I am going to take a break here, and you may have taken a break earlier because you got bored. This is from the Ethos Debate website on topics. I'm going to stop here and come back in a minute. Thanks.